Welcome back. You're watching Stockwatch with me, Zinati Guma. And joining me to take your stock-related questions tonight are Jean Pierre Verster from Protea Capital Management and Mark du Toit from Oyster Catcher Investments. Be sure to send your questions on email at stockwatch@bdtv.co.za or via SMS on 41392 or on X using the hashtag Stockwatch. Thanks, gents. I'm going to start off with the first interesting question. My US portfolio is up at 47%. My euro at 10%. JSE is a laggard at the moment and 1%. What's the attraction? Mark, are you attracted to the JSE and what is the attraction for you?
Yes, well, I mean, I guess the first thing to say is that you don't have to buy any asset. I mean, you can choose which assets you like to own. And I mean, if you're unconstrained and you can pick from a worldwide list of stocks, then you must do your best to pick the best companies. So you don't have to invest anywhere. The JSE return that he's referring to sounds quite low. Yet to date, I think the all shares up about 18%. So I'm not sure where the 1% comes from. And then also you've got the currency impact as well. So our rand has strengthened, I think it's about 6% against the dollar this year. So, you know, it depends which currency you measure your return in as well. But yeah, I guess, so there's a lot of factors and you choose the best investments that you can find. And also for a lot of people, it's easier to invest in the JSE because you don't have the difficulty of taking money offshore. You also have to trust which broker you use. So in South Africa, we have a number of really reputable brokers that, you know, you're not going to have your money stolen by someone. So, I mean, I think there's a lot of factors to consider.
Well, a thing to zoom on here is that the viewer says my portfolio, my JSE portfolio is up 1%. JP, what would the viewer have needed to do to make this more than 1%?
Well, Zanati, it probably comes down to stock picking. And by the sounds of it in the US, probably a lot of technology shares in that portfolio. There was a late announcement today of ASML, which said that their forecasted chip sales are going to be quite a bit lower than expected, or rather semiconductor equipment sales are going to be lower than expected, which has a knock-on effect on chips and everyone in the semiconductor industry. So the viewer's portfolio in the US might look slightly different if he looks again tomorrow, because a lot of tech shares in the US are down quite sharply as we speak. But some shares in South Africa have done very well, maybe not as well as NVIDIA year to date, but I mean, a share like Lewis, to take one example, they sell furniture, Zanati. It's almost doubled over the last year. Wow. A share like Transaction Capital, down in the doldrums a year ago, more than 100% return since then. So we don't have NVIDIA in South Africa, but we do have some furniture sellers and financial services businesses that every now and then can also deliver decent returns for investors.
All right. Well, something that really has not delivered good news to investors for a while is Sasol, and there are actually so many questions on Sasol. But I'll start off with this one that is asking, why is Sasol in free fall today? I think it was down more than 5%. Mark?
Yes, so well, today in particular, the oil price came off quite sharply. So there are a number of factors, but most recently, the oil price was up on the fear that Israel was going to strike Iran's oil assets, and which would cause a bit of a supply shock to the system. And then Israel Prime Minister came out to say they're not going to do that. They're going to rather concentrate on military targets. So that was today's news on why the oil price was down. But also other information that came out today was the aggregate total world demand in China, which is a number that came out which showed that the Chinese are consuming less oil than they did a year ago. As with all data out of China, it's always, you always need to worry about, is it accurate or not? It's not always that accurate, but it's just another indicator. And we know that China as a country are trying their best to move away from fossil fuels, in particular oil dependency. And they're pushing the BEV market very hard, renewable market very hard. So there's all these factors which together push the oil price down today. And of course, Sasol is very geared to the rand oil price, so it was also down.
What's interesting with the next question is that they're asking for your view on Sasol for the short term and not necessarily for the long term. JP, yeah, short term, and would you actually only just be looking at Sasol over the short term rather than the long term?
I would short it over most terms. I'm not a big fan of Sasol. I do think that it is in effect a value trap. The returns, they'll struggle to generate a sustainable return on equity above the cost of equity. And then you have a few big problems on the horizon as well, whether it is gas running out in Mozambique, which is happening, whether it is the carbon footprint of the Secunda operations, which is the worst in the world, whether it is the source coal of the Fischer-Tropsch process, which at some point is going to run out. They still have quite a number of years of coal in the ground, but still, it's so dirty. So no, I would not be invested in Sasol almost at any price. I know that an asset at some price, even a terrible asset, can be a good investment, but not for the long term, only for a short-term spike. And the problem with Sasol is you don't know when that spike is going to come, and probably the spike is going to be followed by another downward move. So I'm just putting Sasol on the too hard pile, but every now and then I would be tempted to short it.
All right. Well, let's go into PGMs. There's a question on Amplat's view on Anglo American Platinum and what the further potential risk is regarding its demerger from Anglo American within the next year. Would you say that there's still quite a lot of risk in terms of the share price movements that we could see there, Mark?
Well, yeah, I mean, in the short term, what we saw recently is Anglo American placed some of the Amplat's stock in the market. So that's where they can offer shares for sale, and it's typically quite a quick process, an overnight process, and institutional shareholders or institutions can bid for those shares. Typically, they get them at a bit of a discount to the current trading price. So I think that it is likely that Anglo American will place more Amplat shares into the market, which in the short term is a bit of an overhang. So people or investors will say, well, I'll just wait for the placements. I'll get my shares at a bit of a discount. You know, there's no need for me to rush into buying Amplats now. But if we fast forward in a year's time, once the demerger is complete, I think Amplats then starts to look quite interesting, because typically we see companies that get spun out of holding companies or out of bigger groups. All of a sudden, there's a lot more focus on the actual business that's now a freestanding business on the market. And they'll be marketers of their own destiny. They can decide on their capital allocation. You know, they might decide to invest more if they think that the demand is going to improve. And I think the Amplats will be more interesting in the medium term. But in the short term, there'll be this overhang, and prices probably won't go up materially unless the PGM prices have a rally.
JP, yeah, I mean, does one then just stomach the maybe short-term volatility there on Amplats and really hold on for when it is completely out of Anglo American's hands?
Well, I do think it comes down to the last point that Mark made, and that is the PGM spot price or basket price. I think that would determine your view on Amplats. So notwithstanding the whole, call it, technical setup with the unbundling and potential placement of shares, and when they ultimately unbundle, there's going to be a calculation about what proportion of the shareholder base is offshore, and that will lead to a tax bill that Anglo American must pay. So there's quite some complication around that. But the PGM price will drive Amplats more than these technical factors in my mind over the coming 12 months. So if you are bullish on the PGM price, which has just kept falling over the last 3 years, if you think it's near a floor, then I think you can seriously look at Amplats. Or if you think that maybe PGMs will stay under pressure, we're not yet in a hydrogen economy, and notwithstanding hybrid EVs, less PGMs are being used in catalytic converters. The EVs are slowly but surely, a little bit slower than anticipated, but still taking over the internal combustion engine market when it comes to motor vehicles. And therefore, if you're not positive PGMs, then I would say stay away from Amplats. So that would inform your decision.
Well, let's stick with the Anglo stable. There's a question on Kumba here. Your view on iron ore in light of the China stimulus. Mark?
Yes, so, I mean, iron ore has been a very volatile market in recent years. I mean, we saw the iron ore price really spike up to, was over $200 a ton and come all the way back down to $100 per ton. So again, another volatile commodity market. For the last 30 years or even 40 years, China's big property boom has driven demand for steel, and iron ore is used in making steel, and that's driven the iron ore demand as well. So we're now sitting in a different scenario in terms of Chinese macro policy. I mean, they want to move towards a more consumption-driven economy and a less infrastructure and property-driven economy, and they are working their way towards that. So every time they announce stimulus, you see that the commodity shares rally initially, and then when the realization is that it's more around consumption and less around infrastructure and property rollout, then the commodity prices like iron ore tend to pull back a bit. And I think that is kind of where we are now. There is a bit more iron ore supply coming into the market. So there's a big project in West Africa called the Simandou project. So it's going to add more iron ore into the market, which is typically not good for the price. Mm-hmm. So I think that the iron ore price probably sticks around $100 a ton unless something else dramatic happens. The only risk is maybe, which I think is unlikely, that China decides, no, we're going back to infrastructure-led growth, and then they do a real big stimulus package, which is what some people are hoping for. And I think that is unlikely at this point.
JP, then is it worth it to go into commodities if you're playing them based on your anticipation of the impact of the stimulus, or rather just play the stimulus in another way through consumption?
Exactly. So I think consumption is the way to look at it. And I'll give you my stock pick a bit later, which touches on this topic, Zinati.
Okay.
But I would say that if you look at the opportunities out there, and if you are bullish about China and possible stimulus that might come, I don't think commodities is the way to get exposure to that. As Mark correctly says, the benefits to the Chinese economy of stimulus will not be that they're going to build more apartment blocks and use a lot of steel and therefore import a lot of iron ore. It will rather be supporting people to spend more money on consumables, on entertainment, on computer games, on holidays, on cars. And that's the way I think you should gain exposure to what's happening in China rather than via the commodity market.
All right. There's a question. Lots of viewers have been asking this. Jubilee Metals, and I just could not find anybody to ask this question to. So, Mark, yeah, you're helping us today. So, looks cheap on current valuation. Would you be comfortable holding a small cap like Jubilee?
Yeah, so Jubilee is interesting, and I have had a look at their recent results presentation. They're busy expanding their copper operations in the DRC and also I think in Zambia. So there's an area there which is very high, has a high copper content, but these are smallish mines. And so it's in Zambia. So they are trying to buy up as much of these mining operations as they can. They've got 2 that's operational at the moment, and they're also investing in processing infrastructure. So I would say it's a very highly speculative company. I mean, smaller mining companies are like that. They either you have fantastic returns or very little returns. So it's difficult for shareholders typically to hold them. I do think that they have good prospects. They probably will need to raise capital because they want to expand quickly. So I would only have a small spec allocation in my portfolio towards them.
All right. JP, are you allowed to talk about Capitec yet?
Not yet. Give me another month and a half. Give me 6 months to cool down. I'm still lukewarm, given that I was a director till May this year.
Okay.
So I'll pass on that one, Zinati.
We'll let you go.
But I'll say yes. One thing. There's a book out called Stalking Giants by T.J. Stradham. It's just been released. I'm busy reading it. It's a very good book. So if anyone wanted to read about Capitec, buy that book.
I've actually seen it. Okay. Well, Mark, over to you. JP, I'm going to come back to you on African Rainbow Capital, so just think about that right now. Mark, Capitec. And is it overvalued?
Yes,
There's a question of, is it overvalued?
Yeah, so, I mean, fantastic company. They've done a fantastic job. I mean, this year, they haven't said this is my view. I think they actually surprised themselves as to how well their value-added services sales went on their app, introducing new products, and I think that even surprised them, the appetite for their products. Came out with a fantastic earnings update, earnings up, I think it was about 36%, half year on half year. And so, yes, and the share price has also run in conjunction with that, up over 50% year to date. So yeah, it is looking expensive. But stocks that have a lot of growth and a lot of runway to grow, like Capitec, will be expensive. So I think if you've got a long-term horizon and maybe your 1 year return is not going to be as good because Capitec has run so hard, but I think your 10-year return will still be good.
Well, actually, JP, let me hold off on African Rainbow Capital because I want to go to We Buy Cars. And particularly for you, since you have held transaction capital, I don't know if you still hold it, but We Buy Cars, is it a buy?
So yes, still hold transaction capital and still hold the We Buy Car shares we got in unbundling, and we bought more We Buy Car shares when it started trading. I'm a big fan of the business. I think it's one of the best businesses in South Africa. I like the fact that it's still the two brothers, the entrepreneurial team, the Van der Walt brothers running the business, still expanding. Apparently, they're looking to buy a huge facility, or at least develop a huge facility in Cape Town that could be even bigger than what the Dome is in Gauteng. So the more parking spaces they have for second-hand cars, the more cars they'll sell, the more money they'll make, and the bigger the dividends to shareholders. So it's not cheap anymore. Like a trading update is probably imminent. It will probably come out very soon so we can hear what the latest is with the business. But I really like this business. And I think, like Mark also said about some other businesses, when it's a high quality business, the shares can get quite expensive. And the worst thing you can do is then sell a high quality company because it looks a little bit expensive based on short-term metrics.
Yeah.
Because chances are it's going to become more expensive, the business is going to outperform, and you're going to make an opportunity loss, which is sometimes a bigger loss than an actual loss. So we're holding onto our We Buy Car shares.
All right. Well, let's go into African Rainbow Capital. Your view on buying it, Mark?
Yeah, so it's not a company that I look at closely. I know that it always looks like it trades at a very big discount to its net asset value, but holding companies will do that because of things like management fees and also the uncertainty as to what happens with the cash. They don't always dividend out the cash. They might look to reinvest it in other businesses. And so holding companies normally trade at quite a big discount. I know that does look cheap on an NAV value, and also their investment in Time Bank looks interesting, but we're not a holder at this point.
Okay. On your side, JP?
Similar view to Mark. The one thing that really bugs me when it comes to African Rainbow Capital is the way that they work out their performance fee. So just about any other investment holding company would work out the performance fee based on a per share NAV. And that aligns the interests of the outside investors with the interest of the people running the investment holding company. In the case of African Rainbow Capital, they don't do it on a per share basis. They do it on an aggregate basis. Now, most of the time you get to the same answer, except in years when they do have a rights issue. And they did have a rights issue in the past year, which means that on a per share basis, you did not see a lot of growth in the NAV. But in an aggregate basis, you did. And they paid themselves a performance fee based on their aggregate performance. And I don't like that. I don't believe it's fair. So that's the one proviso I have that would stop me from investing in African Rainbow Capital. even if I like the underlying basket of assets. I really don't like the performance fee structure.
All right. Well, let's go into gold. Pan-African Resources, it's rallied this year, but with the gold price where it is, it looks like Pan-African still has to rally a lot to be fairly priced for the current gold price. Is there an upside here? Mark?
Yeah, so Pan, I mean, they own the Barberton mine. It's a very it's quite a rich mine, and they're very astute operators as well. The share price has done well along with the gold price. I guess in my view, I mean, we prefer the more liquid gold counters. I think that there's more upside in Anglo Gold at this point. I think that the reason why we prefer Anglo Gold is that there is potential when it gets its listing in the US, that it'll go into indices in the US, and there'll be more institutional interest in the share than Pan. Pan also recently went into an index, and there has been increased buying because of it. But yeah, my preference would be for Anglo Gold over Pan.
Well, JP, here's one. Not a lot of people ask about it. Adcock Ingram. I'm interested in their performance for FY24. I've watched the CEO's analysis of the annual financial statements. Yeah, please could you discuss Adcock's performance? Yeah, your view, JP, on Adcock Ingram. Is this one that is on your radar?
Yes, I like the business, solid business. So you need to think of it in terms of its over-the-counter type products, and it's more scheduled pharmaceuticals, and they've got some hospital products as well. And they went through a bit of a wobble through COVID, but at the moment it seems like the divisions are doing okay. You'll never get amazing growth out of it because it is a regulated industry. The single exit price determines the type of price increases they can push through on the scheduled medicine side. We didn't have a very cold winter, so I'm not sure how the OTC division would do. Normally they do very well when there's a lot of flu going around, although there was some swine flu going around. So who knows, maybe people bought some OTC products from Adcock for that because most other things didn't help. And then you have an Indian pharmaceutical company, Natco, that has bought a small stake, which is also interesting. So even though Bidvest effectively controls Adcock Ingram, it doesn't quite fit as this other listed company that Bidvest has got a share in. So something has got to give. Something probably changes at some point, whether Bidvest takes over the rest of Adcock or sells their stake to someone who's also a pharmaceutical group and can actually wring some synergies out of Adcock Ingram by allowing their products to be distributed in South Africa via distribution agreement. I think there's some opportunities there, and it's not too expensive. So I like Adcock Ingram.
All right. Well, talking about opportunities, let's go into your stock picks for today. Mark, what are you choosing?
Yes, so tonight I am picking Mondi. So, I mean, the South African, in the listed space in the JSE, the South African stocks have performed very well post the election. And we're starting to look at what other opportunities we can find. So we're looking at Mondi. We like it. We think that it is a cyclical stock. It is well placed for recovery in the macro environment in Europe. As interest rates come down, growth rates will improve, and this will be a tailwind for Mondi. Coupled with that, they've just finished a big investment in additional capacity, and that capacity will feed through over the next 3 years. So that's another additional accretion to their earnings. And then they recently did a deal where they bought the Schumacher paper mills. It was a fair deal, I think, and I think that also it was a signal to the market that they're going to look to do smaller bolt-on deals and not try to do a big acquisition, which we would prefer as well. So I think, I mean, on our numbers, earnings should grow in the mid-teens, and you get a nice 4% dividend yield, and the share price is basically slightly down for the year, so you're not paying up for the future returns.
All right. JP, on your side, what are you picking?
I'm going for a Hong Kong listed share, BYD. Stands for Build Your Dreams. It's the leading electric vehicle manufacturer in the world. They sell more EVs than Tesla does. And we said earlier that maybe looking at what's happening in China, getting some exposure to the Chinese consumer would be a good idea. I think BYD gives you that. But more than that, they're also exporting the EVs, and they're really getting market share around the world. And notwithstanding the fact like the EU, for instance, are putting up tariffs, BYD has got some factories now in other countries, like Hungary, which allows them to manufacture and sell in Europe and get around those tariffs. In South Africa, you can buy the Dolphin, and you can buy the BYD Seal, and next year you can buy the Sea Lion, and then the Bucky, the Shark, will come as well. So there's a whole list of BYD electric vehicles you can think of to buy in South Africa. They've got a lot of power, and the infrastructure is also gaining ground for you to charge your EV vehicle, even in South Africa with electricity challenges we've had. So with a very good story, a little bit of a spike in Hong Kong, but it's fallen back another 10% the last week. I think BYD shares offer value around here.
All right. Well, thank you so much for your time and for your analysis today, gents. Really appreciate it. That is all for tonight's Stock Watch. Thanks to our guest, Jean Pierre Verster from Protea Capital Management and Mark du Toit from Oyster Catcher Investments. Up next, I am back with the close. Stay tuned.